And I want to take a step back for one moment. Think about the conditioned marketplace that we have. We've become so conditioned by the Federal Reserve. Nobody likes a 5% pullback, let alone a 10% pullback like we've had in the NASDAQ 100. So in the last 18 months, we've become so conditioned that the market can't go down. So sure enough, we have had elevated volatility as expected. We're seeing the 10-year note have one of the high velocity moves that we didn't anticipate, as it's at 1.88% right now. So it makes all the sense in the world that this survey reveals a bit of bearishness or a bit of confusion when it comes to risk appetite. But at the end of the day, I do believe that the Federal Reserve is not going to have a misstep. I do believe that this is very healthy, and this is typical of a market cycle. Normally, we have 3-5% pullbacks within a year. Now, all of a sudden, we have one. People are trying to crawl underneath their desk. But this is an opportunity. So I'm optimistic here, and I think you have to have proper exposure as we really are grappling with this growth and value situation.
All right, what should we, in the stock market terms, nothing else, expose ourselves to?
Well, Sully, I think now is the opportunity when you look at some of these laggard names. Look at a Boeing, look at a Lockheed Martin, look at the airlines buy in general. We're still trying to work through Omicron and whatever potential variants come out. But as we have optimism and some hopium to go back to some form of normalcy in Q2 of 2022, I think there really is an opportunity to own some of these names. But I do have a tilt. We talk about a lot of the essential names, those epicenter names. They are coming back in vogue, but don't throw away technology. We still like semiconductors. I still think you have to have exposure. Look at SOXX. That's the broad swath ETF. And then lastly, one other sector I want to talk about. I know interest rates are moving higher, Sully. I do believe that 2% is the ceiling in the 10-year note, but housing is pulling back a little bit, but we still like housing. We still like Home Depot, even though it's had a rough start to 2022.
Yeah, you do like housing, even with rates potentially on the rise, Jeff? I mean, mortgage rates have got to go up.
So you look at any tier one city, Chicago, New York, LA, the supply component really is underserved right now. We're seeing demand in all these suburbans as people continue to look for more housing, more opportunities to work from home. Therefore, I think despite the fact that interest rates will move higher, historically, interest rates are very low. And that supply component, so look at ITB, that's a broad swath home construction ETF. That gives you exposure. I still think there's more room to run there. But Sully, there's going to be volatility. The VIX is only at 23. I think people have to really understand that this is normalcy. We've been so conditioned for so long by Fed Chairman Powell and the massive amounts of liquidity that's been injected. No one likes a 1% pullback, let alone a 5% pullback in the S&P 500.